America, we got downgraded. Let's talk about it on Today in Mortgages. Hey, what's going on, everybody? Welcome back to the show where we're talking about what's real, what's hype, and what you should be actually paying attention to out there in the world of mortgage and real estate news. It's Today in Mortgage. I got Rich Jefferson back with me again in the hot seat. How you doing?
I'm good, Michael. Thank you.
Good. Well, as you can see, I'm wearing my America shirt today. You were complimenting it before we started rolling, and I'm wearing it because America is going through a tough time. We've been downgraded again. It's happening. Rich, tell us what happened. I guess this was yesterday, correct?
Yeah, well, Fitch downgraded us. There's other analysts that do this, and I'm wondering if Moody's is going to follow and others. But I watched an interview on CNBC yesterday with a Fitch rep talking about why. You know, the Treasury had to borrow another $278 billion to cover some losses due to, partly due to SVB and Signature Bank losses that happened earlier this year. So that was a big piece of it. And then what he said was, it's the main piece is because there's no governance. Our politics are terrible and nobody can get things done. This constant juggle with the debt ceiling and all of that it makes investors nervous. And so when you do that, I mean, just take us personally, right? If we go jack up all our credit cards, what happens to our credit score?
In the tank.
It doesn't matter if we're paying them all. It's a sign that there's a problem to an investor or to a creditor. And that's basically what's happening now. Right now, there are other investors outside of, well, even within the United States, but they're looking at us going, are they really going to default on something? Are they really going to be able to pay all this debt? I mean, look at what happened during the pandemic. $5 trillion was added to our debt. 1.8 trillion went to businesses, aside from airlines, aside from healthcare, aside from others. 1.7 trillion went to families and individuals. That is a lot of money pumped into this economy, which is partly why we're, in this inflation area, but it's just a lot of debt.
Yeah, what you're saying is America's credit utilization is a little too high. So bringing that credit score down, man. Well, like you said, Rich, this kind of came at a weird time. Like, we got past the debt ceiling thing. We got past the banking crisis. We feel like maybe the dust has settled on those things, and these credit agencies are kind of looking back and saying, okay, what are the root causes of these things and what can we expect moving forward? And tell us a little bit about, for people who aren't familiar, like what level we got downgraded to and where that kind of stands.
Well, I do want to make something clear. The U.S. economy and our ability to pay is the best in the world. Like,
America.
This is not like nothing's caving in. But we were downgraded from AAA, which we should be, to AA+. So it's, for us, it's like going from an 850 perfect FICO to a 800. It's still incredible. It's just not 850.
Still a good place for people to park their money and a good bet that we're going to be able to pay our debts. So, yeah, this happened several years ago, and I think it was Moody's at the time. Is that right?
Yeah, Moody's in
downgraded
2011.
us. And so that pops back. I'm sure we'll pop back again. But like you said, the big piece of this is governance and like what the expectation is moving forward. And I think the thing that we have seen since that last downgrade is the fact that maybe there's a little less confidence that our people can get it done. There was a little more fear this time that we might actually default on some stuff when we hit that debt ceiling. So, we'll see. It's interesting to look at. Rich, before we talk a little bit more about what this means for mortgages and our industry, I want to take a quick break to remind everyone out there that we do have a really great free resource that you go and check out. It is 5 great ways to get ahead while the market is down. It is an ebook. You can go check that out. It's completely free, and it's at todayinmortgages.com. So go check that out. Get ahead in your marketing. We're talking about this kind of in the macro perspective. When we zoom into the mortgage industry, is this going to have any effect on what we're seeing on rates?
Well, rates actually got better back in 2011 after this, but we're in a completely different period. There's a lot of unknown and a lot of things that still need to shake out. I mean, there's a lot of other ancillary issues going on. I mean, Bank of England bumped their fund rate, 25% or 25 basis points just recently. And there's a lot of other little stuff that's affecting this, the mortgage market also. But keep in mind, Fannie Mae and Freddie Mac are GSEs, they're government-sponsored entities, and they were also downgraded right after the U.S. was downgraded. So we'll see what it brings to us for mortgages and to our borrowers. It's just going to take some time.
Yeah, well, it's definitely something to pay attention to for all of us out there that are wondering how all these things that are, like you said, so many balls in the air when we're talking about the economy right now. And this is just another one that we're going to have to juggle in our brains as to how these things will affect our day to day. But ultimately, how are we talking to our people about this, Rich? Should we be getting ulcers?
No. Listen, there'll be some fallout. I don't know what it's going to be, but it's just not going to be that big.
Well, it's a good word, Rich. It was interesting to see this happen yesterday, and I appreciated you coming out and talking to our company about that and how that we should be looking at that. And so now we got to share that with all of the rest of our Today and Mortgage audience out there today. If you enjoy the things that we are talking about on this podcast and the information you're getting from Rich, I want to let you know that, like I just said, he brings the goods every day to our company, the Network Funding, so that we can go out there and win every day. And so if you want to get more insights like that and see how you can be a part of the best network in mortgages, click the Grow link below and we will get you set up with all the information you need to learn more about that. Well, thanks so much everyone out there for watching, for tuning in and listening. We'll see you next time on Today and Mortgages. Today in Mortgages is produced by Network Funding LP, which is an equal housing lender, NMLS 2297. The content of this program is meant to be a commentary on mortgage and real estate news, and any discussion of rates and or products should not be taken as an individual mortgage or home buying advice or pricing estimates. And any commentary on this show should not be considered a promise to make a loan. All applicants for a loan must qualify, and you should consult a professional regarding your individual loan scenarios for your financial situation. Visit our website at nflp.com/licenses for all state licensing and other legal information.